In this video, we'll use data related to three stocks: Tesla Incorporated, Trump Media and Technology Corp, and VTI, which is the Vanguard proxy for the Wilshire 5000, the most diverse U.S. stock market proxy, which is the S&P 500 plus smaller stocks. We will look at data from a small time period from December 1st of 2023 on a monthly basis to November 1st of 2024. We will use this data to show how to use Excel to calculate rates of return, standard deviations, and beta. So starting with rates of return, here we have the monthly Tesla data. If we want to calculate the rate of return on a monthly basis, you just take the price of Tesla in the most recent month minus the month before that, divide by the month before that, and we get a monthly rate of return for each data point. We do the same thing for Donald J. Trump Media Technology and for the Wilshire 5000 VTI. To get the average rate of return, we just use the average function and average the rates of return for Tesla using what's shown up here, average C2, the beginning of the data column, colon C12, the bottom of the data column. We do the same thing for Donald J. Trump, just replacing our C's with an E, and the same thing for VTI, now with a G. And we have the rate of return of these companies, the most diverse investment, VTI, with the lowest rate of return, 0.02, Donald J. Trump with the highest rate of return of 15%, and Tesla in between at 4%. Now, how do we calculate the standard deviation? Well, Excel has a simple function to do that, STDEV, and then you just put in the same data column you did for the rates of return in the example of Tesla C2 colon C12, and replace that with E's for DJT and with G's for VTI. We find once again the most risky standalone investment is Donald J. Trump. The intermediate risk investment is Tesla, and the lowest risk investment is the Wilshire 5000, our diverse stock investments. We could also look at how these stocks are correlated with each other. This is actually a rather unusual situation. If we use the function CORREL, correlation, in Excel, we would figure out the correlation in this example between Tesla and Donald J. Trump by putting in the column for Tesla, C2 colon C12, and common the cola for Donald J. Trump, E2 comma E12, and we get a negative correlation. So when one goes up, the other goes down. That is actually quite unusual in stock investments. What we will most commonly use are correlations with the S&P 500. So here is Tesla's correlation with the S&P 500. And again, all you do is the Tesla column, C2 to C12, column, the column with VTI, G2 to G12, and we get a positive correlation as expected of 0.23. But when we look down here at Tesla, or at, VTI, it is again negative, which is rather unusual. This data can be used to calculate the beta, or you can use other functions to calculate the beta. Let's look at beta from correlation coefficients. So if we use the beta from the correlation coefficient and we want to find the beta for Tesla, we would use first I8, what we just calculated right here, the correlation for Tesla, and then you multiply by H3, the standard deviation of Tesla, and divide by J3, the standard deviation for VTI. We can do the same thing for DJT. Now you have I9, the correlation between Donald J. Trump and VTI, which is negative, then times I3, which is the standard deviation of Donald J. Trump, divided by J3, the standard deviation of VTI. And by definition, the beta for VTI is defined as 1, so that's just going to be J3 over J3, or the standard deviation of VTI over itself. You can also get beta from the slope function. If we look at a graph like the bottom one here, this is a graph on the y-axis of Tesla versus on the x-axis VTI. You can see it's a very rough upward slope of 1.36, and you can get that data from the slope function in Excel, the slope of C2 colon C12, again the Tesla return data, comma G2 colon G12, the VTI return data. Doing the same thing for Donald J. Trump, which has a negative slope, very unusual. It is anti-correlated with the broader stock market of minus 3.48. And again, for VTI, the slope of itself with itself is in fact 1. The final way of calculating beta is from covariance. Excel has a covariance function. It's actually got 2 of them. This one is covariance.s, which means it is a sample, and they subtract 1 for the loss of a degree of freedom. The other one would be covariance.p, which you're looking at the entire data set. With this small of a sample, you will get a different result for each one. So the beta from covariance is going to be the covariance of, in this case, Tesla C2 colon C12, comma G2, comma G12, are the covariance of Tesla with the broad market divided by the variance of the broad market, G2 colon G12. Doing the same thing for Donald J. Trump, we get the same result as the last calculation for beta. And of course, the beta of VTI is by definition 1. All of the data initially in this video came from finance.yahoo.com. I thank you for watching this video.